Hey, Rob from London. That was a great question, and thank you for referring to the chapter in our favorite book. We did turn our pages in the hymnal before we came on to read
We
that
did.
quote. We did. We are that kind of nerd, and so we did read his commentary. And by the way, that is one of the gems of the book. Is you get all the great stuff from Ben Graham, but you also get a lot of the great stuff from Jason as well. He's one of the best finance writers out there. If you've not read any of his stuff, I highly recommend you check it out. It's fantastic, and it's great commentary to the book as well. He did in the book. He talked about kind of two processes. One was doing a paper trading account for a year, and then if that does well for you, then you consider start actively investing in equities. And if you are not comfortable investing in equities, then he recommended doing index funds and 10% in direct equities, like basically individual stocks and that kind of thing. And I think that's great advice. And we've talked about this before. There's nothing wrong with doing that. For some reason, there's this stereotype that you either have to be all in stocks or none, and you can mix and match however works best for you. Andy Schuler, our partner, he talks all the time about different ETFs that he's bought when he wants to start exposure in a space. For example, prior to COVID, I think he bought jets because he wanted to get into some of the airlines and kind of dip his toe into that. And it's a great way to do that kind of thing. And there's so many different ETFs and index funds out there available. For me personally, the reason why I've stayed away from mutual funds, without being too blunt, fees. They're expensive. They're actively managed funds, and they're expensive. And when I say expensive, it's changed a little bit in response to what's going on with ETFs and index funds. But generally, they're higher fees, 2-3% sometimes get taken out of your returns, and then they're actively managed. So they're lots of activity inside the funds. And I just don't feel like the returns on those funds have been anything to write home about. Now, of course, there are fund managers out there that do a great job, and I'm not trying to bash any of the fund managers out there, but studies have shown that index funds and ETFs earn better returns over a longer period of time than mutual funds have. And when you take fees into consideration, it beats them even more. So for me, that's why I've never really talked about them, and I've always kind of been against them. So what are your thoughts on them?
I think it's obvious that ETFs are superior to mutual funds based on the fees. And even if you look at Kathy Wood's ETF, basically kind of like what a mutual fund used to be, except now you can buy it as an ETF. And there's just so much, that next evolution of cost structure has now moved towards ETFs. And obviously people are going to want to go where there's less fees, right? When you look at that mix between how comfortable do you feel between individual stocks and index funds or ETFs, whatever that looks like, kind of goes back to that beginning of the episode where we say your personal comfort level, what you find to be comfortable from a risk perspective. For me, because I've been very involved with the stock market and with the research I'm doing on these picks, I'm very comfortable with putting my whole net worth into them. And that's what I do. I recommend these stocks for the e-letter, and over 95, 96, 97% of my net worth also goes into these same picks. And so that, for me, it sounds conservative to me and I'm comfortable with it. To somebody else, that might sound kind of crazy. So you really have to figure out where you stand on that and position your portfolio that way, but also be familiar with like what are the possibilities and like what are the positives and negatives to doing stuff like that. And hopefully we're able to present those in our show and the various episodes we've done.
I think thinking about some of those ideas, you really need to think about what you're comfortable doing. And if you really enjoy the game of investigating companies and learning the ins and outs of the companies and how they operate and their prospects and their competitive moats and what competition there is among the different companies, if all that stuff is super interesting to you and you love doing that stuff, then looking at individual stocks is something for you. But if you know that you want to invest and you don't want to spend that time, or that stuff just kind of leaves you cold, then there's all kinds of great opportunities and vehicles that you can use to still take advantage of all the great things that the stock market has to offer that allow you to get the great returns that you want, but not have to do all the work that Andrew and I do. We do it because we love it. We do it because we like it. It's fun and exciting. It helps us wake up every morning. Some people, they just don't like that, and that's okay. There's not all of us are built the same. We all have different risk levels. We all have different interest levels, and there's lots of people out there that put money in index funds or ETFs and do it religiously every month, and they retire very wealthy, and they're very happy with spending 5 minutes a day or 5 minutes every month looking at their portfolio, and that works for them, and that's awesome. For me, that's I want more, and so I want to do more. I want to look at more. I want to be more active about it, and I want to have more control and more say over it. And so that's what works for me. But it really comes down to what works for you. The bottom line is it doesn't matter that you follow everything that we do the way that we do it. It comes down to learning the principles and learning how the stock market works and learning how to put your money to work for you so that you don't have to work so hard someday. And it doesn't matter how you get there. And if it's investing in individual stocks like we do, or if it's index funds or mutual funds or your 401k, then more power to you, because that's really what it comes down to.